Highs are being set by a limited number of stocks. Let's go value hunting with Sarat Sethi. He's managing partner at DCLA. He's also a CNBC contributor. Sarat, thanks for joining us at 2 o'clock. It's a rare pleasure. We're glad to have you.
I'm very glad to be on. Thank you, Tyler.
So Bob just talked about the narrowness of, well, that 40% of the S&P 500 is not up for the quarter, and that the rally's been driven by a few very expensive names. There are value stocks that are value stocks for a reason. How do I separate the wheat from the chaff?
So I think, Bob made an interesting point. The stocks that are rallying have earnings growth. And when you look at the value sector, I mean, you just look at value stocks, a couple of the metrics you want to look at is, well, what are they trading at in terms of multiples? And then what I look for is, what are the catalysts? What are the things that are going to drive earnings for the next couple of years, if not more? Those are the stocks that I want to own. So companies, not just because they're value, because they're cheap on a PE or an EBITDA basis, but actually, are there catalysts and are there things that are going to grow margins and revenue?
And what is your catalyst for your first pick, which is CVS?
So CVS is an interesting story. So CVS is a combination of CVS and Aetna. It trades at 10 times earnings. They've had a rough go of it as through the acquisitions. They're a little over leveraged. So the goal for them is to pay down debt. The margins are going to improve. They've got the front of the store with CVS, and they've got the Aetna piece, which trades like the United Health. So we've got a company that's trading at 10 times earnings. Their comps are at 20 when you look at United Health. And the catalysts there are earnings growth going forward as the companies have combined, and value-based healthcare is really increasing. So, earnings growing, high single digits, double digits in 22. Even if you don't get multiple expansion, which we'd expect, this stock can grow, and you have a dividend yield of a little over 2%.
I sit there and I look at CVS and I think, is it a retail company or is it a healthcare company? And I can almost see the investment bankers 3, 4, 5 years from now. The wheels are going to start to turn, and they're going to come out and they're going to say, wait a minute. If you just got rid of that retail with the cosmetics and the milk and the cookies, you'd have a really a much higher multiple. Am I all wet or what, Sarat?
Well, I think what you're looking at is the intrinsic value of the company. So if things don't go as well as planned, they don't execute on what they're trying to do, the sum of the parts is greater than the whole. And at the same time, what is the company doing? They're paying down debt. Mm-hmm. They're basically doing the reverse LBO on themselves. So when you look at kind of what is my downside on this stock, it's pretty limited because they've got great cash flow and the sum of the parts is worth a lot more than the two of them together. But if they do perform and they do get that high single digit, double digit growth, this stock could easily re-rate. You get a multiple expansion on a market that's already trading at 20 times. So you're talking about a stock that's 10. It's a self-help secular growth story in a stock market that's pretty fairly valued.
So, Rod, it's Kelly, and I want to pivot you, if I may. I don't want to call it boring old Morgan Stanley, but I'm curious about a couple of reasons here that you would recommend the stock. Number one, interest rates. Such a headwind for a lot of these financials. And I know everybody says they can do well in a low rate environment, but the stocks never trade that way. Number two, fintech. The more and more that people start as stock trading, they're going to want to go upstream to asset and wealth management, which is Morgan Stanley's bread and butter.
Right. So a really good point there, Kelly. If you look at Morgan Stanley's transformation, and credit to their management team, 60% of their business is now wealth management. Their credit profile is very minimal. They don't really lend money out. They're not using their balance sheets like the Bank of America and JP Morgan's. Yet this company is trading at 14 times earnings. They just increased their dividend, double their dividend to 2.7% yield. They have excess capital. They're going to buy back about $12 billion of share. And really, they're looking at earnings growth from the wealth management business and the M&A business, which is asset light. So interest rates could go up, and that'll be very helpful, but they don't have to go up for this company to actually earn its way into kind of a double-digit earnings growth. So those factors, you get some tailwind with interest rates, but the rest of the business that the management team has done, I think, separates itself from the rest of the pack, and they haven't really gotten the multiple credit yet. And I feel like either you get the multiple credit and you get the earnings growth, or you can get both. And this is a company that's going to increase its dividends too. So growth, value, both these on a very cheap stock.
Shepard Smith here. Thanks for watching CNBC on YouTube.